To reach $1,300 a month in passive dividend income, you don't need a massive inheritance. The mathematics of turning a single one-time $10,000 investment into a steady monthly check are completely mapped out. The problem is how most people start. They log onto forums and paralyze themselves arguing over whether dividend growth or high yield is the right strategy. But obsessing over the highest yield or the absolute safest stock is the wrong starting point for building a portfolio. Before you pick a single ticker symbol, you have to answer a much more practical question. Exactly how many years until you actually need to spend the cash? Defining a strict timeline up front prevents you from executing a technically flawless investment strategy that is completely useless for your actual life stage. Depending on the route you take, turning $10,000 into $1,300 a month takes 27 years, 22 years, or just 14 years. Same starting capital, 3 different timelines. This chart maps out the inescapable trade-off at play here, the inverse mathematical relationship between how fast you get your income and how large your final portfolio grows. To maximize the final size of your total wealth, you have to accept the slowest possible path to usable cash. Conversely, if you secure high upfront yield, you pay for it by permanently capping the portfolio's growth ceiling. Acquiring faster passive income is not a cheat code. You are making a direct transaction, buying immediate cash flow at the cost of long-term capital appreciation. If you have the time, the 27-year path aims for one strict target: maximizing total terminal wealth over immediate cash flow. You get there using dividend aristocrats, low-risk, blue-chip companies that have raised their dividend payments every single year for decades. By accepting a very low starting yield of around 3.3%, you buy into companies with high historical share price appreciation. After 27 years, this stacked bar chart shows that initial $10,000 transforms into nearly $300,000. The majority comes from capital appreciation, adding over $175,000. Reinvesting small dividends buys more shares, adding another $113,000. It creates a rock-solid portfolio. But because early income is near zero, this path is useless for anyone needing cash in the next decade. If you want to accelerate your timeline to beat a traditional retirement age, the 22-year path shifts the focus to moderate growth. The vehicle here is real estate investment trusts, or REITs. By law, this corporate structure mandates passing the majority of tenant rental income directly to shareholders. You capture a higher upfront yield, nearly 4.8%, but expose your capital to the volatility of commercial property cycles. Here's the second bar. You shave 5 years off, but your final portfolio shrinks to $147,000. The engine reverses. Reinvested dividends now build $90,000. The cost is steep. Capital appreciation drops by over $100,000. You are explicitly trading long-term net worth for speed, cutting your final wealth entirely in half just to get your monthly check 5 years sooner. For absolute maximum immediate cash flow, at the expense of all other growth factors, there is the 14-year path. This requires stepping into covered call ETFs, derivative funds that generate massive upfront yields by trading options contracts against their holdings. The mechanics are rigid. To secure double-digit yields today, the fund must cap its potential upside. If the market surges, you don't get the gains. The third bar shows the result. You hit the target in half the time, but the portfolio sits at just $97,000. With upside capped, it's built by cycling dividends into shares. You see a mere $13,000 in capital appreciation. Holding a portfolio under $100,000 while withdrawing income leaves your underlying principal highly vulnerable to long-term inflation. You can reach the income goal in just 14 years, but it requires abandoning long-term wealth creation completely to get there. You start at the exact same $10,000 line and cross the exact same $1,300 a month finish line, but wind up with a $200,000 difference in final net worth. Look at this comparison matrix. None of these strategies are inherently wrong. They just utilize different engines to move your capital forward. Aristocrats dominate in price appreciation for the patient, while covered calls dominate in pure immediate yield for the impatient. Covered calls aren't a shortcut to beat the system, and blue chips aren't perfect for everyone. It is solely about matching the mechanical tool to your specific life stage. Stop looking at stock tickers and definitively answer the core question. when do you actually need to spend the dividends? This flowchart maps it out. If you are in your 20s or 30s with decades to spare, chasing high yield is a mathematical error. You must prioritize wealth maximization with aristocrats. If you are targeting early retirement in a decade or two, you need a hybrid approach. REITs bridge acceptable yield with moderate growth. And if you are older and require supplemental income immediately, less than 15 years out, you must sacrifice terminal wealth to secure maximum cash flow with covered calls. Successful dividend investing is never about finding the highest yield. It is about executing the specific mathematical trade-off that perfectly aligns with when you actually need to spend the cash.